Good afternoon. Just a quick housekeeping item before we begin the session. You can use the session chat to the right of your screen to post any questions, and we'll try to get to as many of those questions as we can during the session today. I'm Suzanne Finnegan. I am the Chief Credit Officer at Build America Mutual. We insure municipal bonds, the timely payment of principal and interest, and our current portfolio is about $67 billion. BAM is rated AA by S&P Global Ratings, and therefore all the bonds we insure are also rated AA. I'd like to start today by introducing our panelists. We have Mark Harris, who's the Chief Investment Officer and Head of Municipal Strategies for Invesco Fixed Income, which is a top 5 institutional manager of municipals with more than $57 billion in assets under management. Jason Metzger is the head of risk management for Pure Insurance, a member-owned property and casualty insurance company that focuses on serving high net worth families, protecting their homes, autos, and other possessions. And then last but not least, Chris Hartshorn from risQ. Chris is the Chief Commercial Officer for risQ, which is a new software company that models the complex risks posed by climate change and is particularly focused on turning those risks into actionable reports for municipal debt stakeholders. So we've seen a number of extreme weather events recently, including massive wildfires, a very large number of hurricanes this season, and significant flooding. You know, the municipal business is a very low risk business, typically characterized by strong security features and solid credit quality. BAM is generally comfortable with most core municipal credit, but we do recognize the potential impact of climate change and how that could impact specific credits. BAM uses a variety of tools to help identify credits which are at an elevated risk. And then as part of our underwriting, we may allocate additional capital to credits that we think are at increased risk, and we do limit our exposure in high-risk regions. So, Mark, I wanted to ask, how is your group incorporating climate change risks into your investment decisions? Do you have strict do not invest lists for certain credits or communities? Or is it something that you manage by looking at the risk reward options?
Yeah, thank you, Suzanne. Good to be here with Jason and Chris. Good afternoon, everybody. So certainly climate change is becoming a more heavily weighted risk criteria in the muni market. It's one of the many risks that analysts have to look at, as you know, Suzanne. But, you know, these are certainly things that you have to incorporate into your decision-making process. You know, we believe we need to look at it in both the long and the short run. The short run, forest fires and how those areas around them have been affected. Things like hurricanes in the southeast that have been hit hard. Obviously, it helps when an insurance company is there and providing the assets to build back and build back strong. And certainly it helps when a bond is backed by an insurer like BAM. And so we do kind of factor those things in. But, you know, in the long run, we also have to think about how areas and particularly developments are changing geographically. Are people moving out because of climate change? You know, are the prices of houses going down? That's going to affect property taxes in a very distinct way. Property taxes are a main way that municipal bonds pay off. And so you've really got to start to think about how that basically affects things. But when you look at it from portfolio to portfolio, obviously there's going to be different reasons why you want to own a particular bond. But we have launched an impact strategy muni fund. We've done it on our own proprietary system. You know, the muni market doesn't have kind of what some of the other markets have, where there's a dedicated rating system to environmental impact bonds, to ESG securities. So we've created our own. We have a fund that's based on it. But there's really 3 criteria in a bond that we look at. Number 1, is it a good credit? Number 2, how does it score in our system? And we come up with a 1 to 5 system. So 5 would be the best. Is it a 4 or a 5 in our system? And then 3, is it a relative value bond that we can actually use and enhance the portfolio and add value for our shareholders? So that's a separate strategy that we're running now, but certainly it's enabled us now to start looking at all the bonds that we own in our $57 billion complex and putting a impact score on that bond, and then seeing how it kind of fits into the portfolio. I think that there's a lot more chatter now about ESG, about impact, and certainly, about climate. And we're going to have to watch how the long run plays out, because I think that property tax issue is a big deal. But certainly where a bond is insured, that's going to make it more attractive for us, where we know that, a hurricane has hit or a fire has hit and the insurance companies are coming in, that helps too. But it's an interesting world that 2020 has posed on us. And so not only do we have all these other issues going on, but we've certainly had a fair amount of climate issues as well.
Great, thanks, Mark. Jason, flipping over to you, for many investors, their real estate holdings are a substantial percentage of their total assets. And so as you look at your insured portfolio, are you seeing a change in the risk outlook for properties you insure due to extreme weather? And, how are you dealing with that?
Yeah, hi, Suzanne. Thanks for having me. It's interesting. We already covered hurricanes and wildfires a little bit, but there's also earthquakes, and those things get the majority of the headlines, and we insure properties where all of those things happen. And in my business, especially, convective storms like the Dallas tornadoes, which happened exactly 1 year ago today, those can often be the most devastating and have proven so for us. Our start 15 years ago in Florida was to solve this problem of an availability crisis for high-end homes on the coast, looking for good prices. And we figured out that there could be a niche for good risks, responsible people, big, new, well-built homes. And we ended up founding the company kind of on that premise. Part of that longer term strategy needed to be diversification out of Florida. But when we got that start in Florida, we knew that there was going to be a period of time every year where you'd have this increased frequency and increased severity, and that you'd have to underwrite diligently up front and understand kind of what the construction quality of these homes were, what kind of roof type they had, the elevation of these homes, distance to coast, if they were on a barrier island, if they had opening protection. And you did things like look at wind versus non-wind coverage and different types of deductibles, and you were able to offer a really competitive product up front. But on the back end, we developed partnerships in a strong risk management function, partnerships with firms like IBHS that have developed fortified roofs and different building codes, relationships with the communities in Florida that would hold those building codes up. And I'm sure everybody has seen by now the iconic picture after Hurricane Michael went through, where there's the one house standing. That house was built to code plus. And you can construct homes that withstand hurricane force winds and those types of storms and the flood surge that comes with those types of things. And so we've always kind of liked our hurricane bet, in part because I mentioned earlier we had a diversification strategy which would help that bet. Wildfire is a little bit different for us. If you think about California, which is one of the wealthiest states in the country and a big market for a company like mine, a third of the population there has some sort of exposure to wildfire risks. Often with our clientele, it's because they like to live in these kind of wild urban interfaces. They're called WUIs, W-U-I in our business. But we have about 2 million potential prospective homes in areas like that. And when you compare this risk to hurricane, there's a lot more unknowns, namely the human element of this. 85% of wildfires are started in some way, shape, or form by a human. Never has a gender reveal party or a lightning strike or an electrical company ever started a hurricane. And when you have to put all of that stuff into the mix for wildfires, you have to start to think about focusing on what you can control once these things start. And so for a P&C insurance company like ours, there's stringent underwriting, but there's the management of your aggregates, there's cat management and response, and everything kind of begins with the hardening of the structure and the use of the fire-resistant materials, the roofing materials, keeping area under decks free from combustibles and other debris, having 6 inches above grade, being fire resistant, having venting on the homes that is small enough to prevent embers from flying into attics. And if you have a good structure, you give yourself kind of a fighting chance. To further fortify that, we'll send risk managers out on site that will walk through the home and around the property to help members identify defensible space, 0 to 5 feet from the home. Let's get all of those little things out of the way. 5 feet to 30 feet. If you have those beloved Italian cypress trees that are basically like lighter fluid, we're going to ask members to kindly remove those, or perhaps they could find an E&S market, for the property. And then beyond the 30-foot zone, we're just going to try to clear that property. And so if you have cleared property from around 100 foot in and you have a good construction quality of that property, you're going to give yourself a fighting chance. And as I was thinking about being part of a group that's discussing municipal bonds, one of the ties here is in the West, in California especially, communities can come together to earn designations. One of them is a FireWise designation, which in essence is the community saying we will all follow a set of rules that help us become a much more resilient community. And what that does for a P&C insurer is say, gosh, a risk on its own isn't something I'd like to take on in an extreme wildfire area like Truckee. But if an entire community is going to come together and work together to keep that community safer than it otherwise might be, it becomes insurable. And that's something that companies will often put capital behind. In addition to that proactive risk management, getting someone from our company on site, having that consultation with our members, asking them to make potential changes to either the property or the grounds to prevent them from experiencing this devastating loss has been a good step for us. But in addition to that, we've created reporting that peer members can have access to if they're thinking about buying a new property, and it might be in one of these areas. Our membership is buying new properties. Often 1 in 7 peer members buys a new home every year. And we've developed a Peer Home Spotlight report, which gives our members some insights into a property before they even purchase it. And so things like hazard data based on typical risks for that geography and threats that home might inevitably face. Loss history of that prospective home could be made available to that peer member before buying that property. Permit data to try to understand what upgrades have been done on that home. Maybe there's open permits that might get in the way of getting that property closed. And then we ultimately give them an insurability rating and help them through this home buying process. It's really valuable when you're talking about the Florida coast, when you're talking about California high wildfire risks, and even when you're looking at homes in the Midwest when it comes to like hail or fault lines or other convective storm issues.
Something that you were just saying is that you're working very closely with your members to help them have more resilient properties. But as we've seen back in Florida years ago when the state actually stepped in to provide cat insurance for the windstorms, there are sometimes markets where commercial insurance simply isn't available, and in those scenarios, I think that also ties into what Mark was saying earlier with respect to property values. If you are unable to get insurance or reasonably priced insurance, right, that can drive impacts on property values, which is very much a core municipal credit aspect. So let's turn it over to Chris. There's multiple scientific kind of questions on the subject. Macro questions like the potential impact of certain levels of carbon emissions on both temperatures and weather patterns, as well as local questions to what Jason was just speaking about vulnerability to floods and wildfires when they occur. It seems that the threat from wildfire in particular seems to have changed dramatically and pretty quickly. Do we know enough to make accurate projections and forecasts into the future right now?
Yeah, thanks, Suzanne. So accurate is always in the eye of the beholder when it comes to forecasting. So it is possible to build the same probabilistic models that any self-respecting catastrophe model would build right now, to build those on a forward-facing basis, factoring in different climate change assumptions that then show you what a given risk could look like 10 years from now, under different climate change assumptions, under different carbon assumptions, and all the rest. So those models absolutely exist, and then it's just a matter of picking the scenario that you believe to be an appropriate likely case scenario, and then building models out from there. So the science, contrary to the rhetoric from some, is actually very well understood, and there isn't a whole bunch of controversy around it in the scientific community. In terms of how to translate that across into the municipal bond space, when you think about floods and hurricanes and wildfire and all the rest, that's actually one of the big challenges, because it's not possible for your garden variety municipal bond analyst to walk the ground as a P&C insurer would do. And so to kind of bridge that gap, we've in essence had to build a catastrophe model using satellite imagery of all the rooftops across the entirety of the US, broken that down into the individual issuers in terms of property value, what the nature of that property looks like, all of the standard stuff that a P&C insurer would do, that then corresponded across to municipal bond issuance. Right? That's essentially what we've had to do. And what you come up with is this linkage, this absolute linkage, which both Jason and Mark have already talked about, wherein property value interactively links to the municipal bond sector. GDP generation interactively links to the municipal bond sector. All of the damage functions associated with every single climate event link interactively to the loss of GDP and property value at risk. These things all exist. Catastrophe modeling has been around since 1992, when Hurricane Andrew wiped out about half the US reinsurance industry. The job is to translate that across the municipal bond space. So if we look at things like wildfire risk, it's absolutely possible to take the property value, distribute that across the unit area of municipal bond issuer, look at what proportion of that property and property value is at the WUI that Jason talked about, and then rank that according to, does this issuer have good, bad, or ugly risk when it comes to the individual wildfire risk, or when it comes to some of the flood risk and all the rest. I think this does come back, again, linking it directly to the insurance space. As both Jason and Mark have already said, a lot of the underlying assumptions around the resilience in the municipal bond space are tied to the historical ability for the financial sector to provide a backstop, whether that be the insurance sector, or whether it be FEMA, or whether it be some other backstop in between. Each and every one of those backstops is looking increasingly more tenuous in its support of the scale of the risk that we're looking at, which is why the insurance gap around climate events is growing, which is why FEMA's appropriation is increasingly delayed every single year, while their budgets are getting increasingly stretched. So anyone that is using historical financial backstops of the municipal bond sector as a forward-facing indicator of future backstops for the municipal bond sector with respect to climate is building a horrifically flawed model that the reinsurance sector in approximately 1992 would be more than happy to educate you on. So we look at insurance uptake rates as the financial health metric of the individual property owners in a given issuer, as one of the health metrics for the municipal bond issuer themselves, because someone's going to have to keep that whole. And if the insurance uptake rate is not high right now, that's going to increase property values later when the insurance prices start to get factored in to the underlying property values that people are willing to pay. So all of these things are intractably connected but we need models to build this out, and that's exactly the square that we've been circling. And actually, we're coming back around to square exactly the same circle in the mortgage-backed security space as well, because whether you're looking at muni bonds or looking at residential mortgage-backed securities, these are all predicated on residential property value, how fast it can be restored, tying that collateral to securities, and informing the fixed income sector as to what their inherent risks are like and what they look like on a forward-facing basis, regardless of what sector of fixed income you might be looking at. All of those things have got to be solved, and I think this is actually an interesting panel to kind of come together on in that triangle.
But, to follow up on something you just said, Chris, you mentioned FEMA and how that has been historically a backstop. In fact, many municipalities that are located in these higher risk areas view FEMA as their insurance company. They don't typically have commercial insurance for these kinds of events. They may have cooperatives that they participate in or state-funded pools, but they don't typically have individual asset insurance. And, I think we've seen that FEMA has been slower to pay, but also now focusing in on properties that have had multiple significant losses and are reluctant, I think, to continue providing insurance in those cases. We've seen, and I don't know if you've seen this, but instances where FEMA now is just purchasing the property, which again takes it out of the tax base.
Yep. So it comes in play in a couple of ways. It absolutely makes it non-taxable property. So that is absolutely true. If you think about it from a residential mortgage-backed security perspective, that is a prepay event, which means it's going to change a lot of your prepay metrics on the MBS side. But the important thing about FEMA is it was never designed to be a 100% backstop for municipalities. If you look at the funding that goes in there, it's only generally 75% at best, which means 25% has to come from somewhere else that is not the individual taxpayer. And furthermore, there is a delay on those FEMA payments, and there is a cost of money that falls to the balance sheet of the individual municipal bond issuer in the interim, while FEMA is even determining what proportion of that backstop they're willing to provide.
Right. And then, Chris, we have a question from the audience for you. Would you personally invest in municipal bonds today?
Would I personally invest? I'm sure I am personally invested in municipal bonds today. I think there are certain bonds that I would look very closely at on the same criteria that Mark would be more than willing to inform this community on. I think if I was looking at it from a climate perspective, I would be very hesitant if you looked at historically where the sectors in the muni bond space where impairment has come from in the past, and those are well-known sectors. Those are your CCRCs, some of your hospitals, some of your dirt deals, which are generally high yield in the first place. I'd be very hesitant to take on a double whammy of historical impairment coupled with a high propensity for climate risk, because I think as climate change continues to go forward, particularly those longer maturities on historically impaired sectors, are going to start to look a little bit smelly on the balance sheet.
Got it. And there was another question for Jason. Would you like to see more government action to manage these risks, i.e. adjusting building codes, things of that nature?
Yeah, I certainly think that would be helpful. But I also think that it's an education that's partly the responsibility of the insurance industry and partly the responsibility of the home builder. If you look at California as a prime example, the data is clear, the trends are clear. Every year is becoming more and more devastating. Just this year alone, which isn't even over yet in terms of the wildfire season, the monitoring of the potential exposures that we have relative to the location of these fires is up 150% over last year, which was also a devastating season. the response of our private firefighting units that will go out and remove combustibles and spray foam homes is up over 400%. Thankfully, our outcomes have been good, but there's a lot of preventative work that goes into this. It's a combination of building it right and keeping that space and having these resources. And the more that we share that and the more that people who are building in the WUI understand that, the better chance we have to defend it. It's one thing we're sure of, like peer members want to build where they want to build, and typically, we can help them with that. When you get into situations like Paradise, where it is a little bit less likely that you're building new construction and you are where you're at, I think that's where the government direction could really help.
Great. Okay. Well, I think that is it for us time-wise. Mark, did you want to just quickly add anything about your fund, the ESG investment there?
Yeah, so I think, look, I think people sometimes assume ESG and impact means lower yield and less risk in the marketplace. That's not necessarily true. If you do really good fundamental research, and again, we have a proprietary scoring system, and we don't want it to be exclusionary. For instance, we don't buy toll roads right now. I happen to have an electric vehicle, but not everybody does. So we sort of exclude those, but there's a full universe that you can invest in and still get competitive returns and yield in the marketplace. And I really want investors to think about ESG and impact in all sectors and all markets as not so much limiting their possible returns. It's just a different way to invest.
Great. Well, I want to thank you all for attending today and thank the panelists in particular. We're going to take a short networking break and then meet back at the main stage at 2:45 p.m. for the remainder of the program. Thank you all.